So, let's talk about one of the biggest problems traders face when they're using smart money concepts: ICT, supply, and demand, whatever you want to call it. You identify the trend, you see the structure, you mark your zone. Everything looks clean. Then the market pulls back, and suddenly you're staring at multiple areas where price could react. There's a zone here, there's another one just above it, maybe there's even a third one above that. Which one do you use? If you pick the wrong one, you take a loss. Pick the wrong one again, another loss. And if you're not careful, you can rack up 3 or 4 losing trades back to back without ever catching the actual move. That's not a strategy problem. That's a clarity problem. You're missing one key piece of the puzzle, and that piece is understanding inducement. Once you get this, you'll know exactly which zone to focus on, which ones to ignore, and why the market moves the way it does in the first place. So, let's break it down properly. When the market is moving in a clear trend, in this case, bullish and going up, there will sometimes be more than one zone you can use for your longs. This is where inducement zones come in. For example, here we have the inducement zone, which is the red box, and then we have the true zone, which is the green box. Now, an inducement zone, or inducement in general, is simply a trap, is an area on the chart that looks like a good place to enter, but most times it will not hold. So, this inducement zone may attract buyers to enter the market when the price reaches it. You might see zone and decide to go long here. But what often happens is that these inducement zones do not hold. Instead of reacting from that level, price pushes through, moves toward the true zone, and then continues with the larger move. Now, the reason this happens comes down to liquidity and imbalance. An imbalance is an open price range. This means a demand zone like this that has not been retested yet. If price had pulled back and retested this demand, then this zone in red would have been a valid zone to buy from. But because this imbalance is still open, there is space here where liquidity sits. In this area, there are stop losses from buyers who entered early. There are also sell stops from traders looking for a breakout. On top of that, there are many orders sitting here, and these mostly come from institutional traders. We know this because the market is mainly driven by institutions. The big moves we see are not caused by retail traders because our trades are too small to move the market in that way. So, because of this open imbalance and the liquidity sitting in this area, we can expect price to move lower instead of respecting this first zone. Price will push down to fill the orders in the lower demand zone and also take the liquidity below this swing low. Now, you might be thinking, why not just place a buy limit at this zone and also at the lower zone? That way, no matter where price goes, you get into a trade. The problem with that approach is simple. If the first zone fails and second zone also fails, you do not take one loss and one win. You take 2 losses. So, if there are 2, 3, or even 4 demand zones in an uptrend, you should not buy from all of them. Doing that can easily lead to a 2, 3, or 4% loss in a single day, which is not good. What you should do instead is use this understanding of inducement to focus on the best zones. This helps you choose the right areas to buy or sell from instead of taking every setup you see. Let's move to a live chart example so you can see exactly what inducement looks like in real time, how to spot it, and how to use it to your advantage. This is where the idea starts to make sense. It is one thing to hear about inducement in theory, but is a whole different thing when you learn how it behaves on an actual chart. Now, looking at this part of price action right here, we can see that there are several places where a buy could seem possible. At first glance, it may even look a little confusing because there is more than one demand zone on the chart. But if you slow down and read the structure properly, the picture becomes much clearer. What do we know first? We are in an uptrend. Price is making higher highs and higher lows. That is the main clue. When the market is doing that, we do not want to fight it. We do not want to start looking for sells just because price looks high. In a clean uptrend, our bias is simple. We want to buy. The only problem is that there is more than one demand zone that could catch your eye. There is a zone near the top. There is another one a little lower. And then there is one more down at the extreme. So the real question is not, can I buy? The real question is, which zone is worth buying from? That is where the skill comes in. Let's start by removing the weakest zone first. The top zone is not the one I would trust. It may look fine on the surface, but when you check what is sitting underneath it, you can see clear imbalance below that area. That means price has not fully balanced out there yet. Markets like to come back into these unfilled areas. They get drawn toward them. So, if we try to buy from that top zone, there is a good chance price will push straight through it instead of reacting from it. That makes it a low-quality zone. So, we can throw that one out. Now, we are left with two zones. One is the middle zone. The other is the lower zone near the extreme. At this point, many traders would rush into the lower one because it looks deeper and safer. They may think, this one is stronger because it is lower, and there is more imbalance above it. But you cannot pick a zone just because it is lower. You have to ask what that zone actually did for the market. So, let us read the structure. Price made a low down here. Then it pushed up and formed a higher high. After that, it pulled back and made a higher low. Then it pushed up again and made another high. But this part is important. That high was not a proper break. Price only wicked above it and then got rejected. That tells us something very important. The market did not truly break structure there. It only tested it and failed. That is not the same as a clean breakout. It shows that sellers were still active and that the move was not strong enough to continue the trend from that point. So, even though that area may have broken some internal structure, it did not break the main swing high that mattered. That means it is not the most powerful zone on the chart. It is more like a smaller shift inside the trend, not the real place where strength was built. After that rejection, price dropped again, then pushed back up and finally broke the high properly. That later move gives us the real higher high. That is the valid one. That is the part we care about. And this is where the clue becomes clear. We always want to know which demand zone had the power to break the structure that matters. That is how we judge strength. If a zone cannot push price into a new swing high, then it is not the strongest zone. If the market has to come back, reset, and build again before it breaks higher, then the earlier zone was not strong enough on its own. That is what we see here. The low zone did not create the true break in structure. Price had to come back, gather strength, and then continue. The zone that helped produce that real push was the middle zone. That means the middle zone is the stronger one. So now we can make a better choice. The top zone is weak because of imbalance. The bottom zone is weaker than it first looked because it failed to drive price into a proper structural break. That leaves us with one zone that stands out above the rest. The middle, demand zone, is the one we care about. This is the true zone. Now, that is the important of inducement. That is why you cannot just look at the chart and buy the first nice-looking zone you see. You need to ask yourself, is this the real zone, or is this just a trap zone? In this case, the true zone is the middle one. The lower zone becomes more of a backup area, not the main one. If the market goes all the way down there, that would mean our main idea failed. It could still give a reaction in some cases, but it is not the strongest location to build a trade from. So, what do we expect now? We expect price to come down into the true demand zone, maybe even sweep a bit lower to take liquidity, and then push away hard. That sweep is what often fools traders. They see price break below the level, panic, and think the market is done. But that move below can be the very thing that triggers the next rise. This is why inducement matters. It helps you understand where the market is trying to pull people in, and it helps you stay patient while others get trapped. Now, if you want to trade this in a safer way, do not enter the second price touches the zone. Wait for proof. I like confirmation for this, and that is the smart way to handle it. So, once price comes into the true zone, we drop to a lower time frame. On the hourly chart, for example, we may go down to the 10-minute chart to watch for a shift. What are we looking for? We want to see the market stop making lower lows and lower highs. We want to see it turn into higher highs and higher lows. That shift tells us buyers are taking control again. If price sweeps into the area and then we see a strong move up right away, that is a very good sign. It means the market did not just tap the zone. It reacted from it with force. You can also use the 15-minute chart to get a better look. On the 15 time frame, we see that this was a major wick rejection, meaning once the market came and swept the low, we had an immediate drive up in bullish momentum. Not just enough to form a pin bar, but also enough to actually form a new break in structure, which would be this lower time frame structure. This high, just here, is broken, and as you can see, the market's closed above. At that point, you can refine your entry even more. On the 10-minute chart, the last bearish candle before the impulse up often becomes the demand zone you want to mark. That candle is important because it is usually the last point before buyers stepped in and pushed the market hard. That is the zone you can use for your entry. So, the plan looks like this. Price comes into the true demand zone. You wait for a shift in structure on the lower time frame. You look for a strong reaction and a break in the smaller trend. Then you buy from the refined demand area. Your stop loss goes below the low that was swept. Your take profit goes toward the previous highs because the main trend is still up and we are expecting continuation. That gives you a clean trade plan with a clear reason behind every step. This is why inducement is so useful. It helps you separate the weak zones from the real ones. It helps you avoid buying too early. It helps you wait for the market to show its hand before you commit. So, if we step back and look at the whole move again, the story is simple. We had an uptrend, We had several zones that looked possible at first. We removed the top one because the imbalance below it made it weak. We removed the extreme low as the main choice because it did not create the true structural break. That left the middle zone as the real one. That zone is the one that built the strength needed to push price into new highs and keep the trend going. And that is the zone we want to trust. So, the next time you see a chart like this, do not just guess. Read the structure. Look at the highs and lows. Check where the real break happened. See where the strength came from. Then decide which zone deserves your attention. That is how you stop taking random entries. That is how you stop getting caught by inducement. And that is how you start trading with more patience, more confidence, and more control. Thanks for watching. I will see you in the next one.